This is a stock analysis on the company Smith & Wesson, ticker symbol SWBI. This video is inspired by a StockTwits user, so if you want to chat with me directly or just follow my super honest and, I don't know, sometimes weird StockTwits, you can follow me at Slavilenkov, I think one word. I'll try to include it down in the description of the video if you're interested, but anyways, I did a video of this company about 9 months ago, and at the time I thought it was a bit overvalued. I don't know if I owned any shares at all, but I was warning about the unsustainable growth that the company was experiencing, and subsequently we've seen quite a decline. Now, of course, in typical my fashion, I jumped the gun too early and I started buying the stock at around $15 a share, and now it's at around 10. So obviously I'm losing. I've been selling put options to try to scale into the position, and now I own like over 8,000 shares or something like that. So I'm definitely in line with everybody who's watching this if you own Smith & Wesson, and I've done some more extensive research than I did the first time around, but this video is not going to be as edited as before, so just sit back, grab a drink, relax, and chill. All right, I know that it's unedited and I say a lot of ums and pauses, all right? I'm aware. But if you don't enjoy it, that's fine. But if you want to listen to what I have to say, here we go. So first we're going to go into the stockanalysis.com, which is my favorite site so far, free website to look at data. I don't feel like paying $10 million for a Bloomberg terminal, so I'm going to use stockanalysis.com. I'm not affiliated with anyone, just in case you're wondering. But here's the stock. It's trading at 10.35 right now, minus 1 cent in the after hours, which is actually a very good day considering the entire market tanked on Friday with a tiny bit of a revival towards the end of the day. Now, this may seem like strong behavior ending up in the green, but you got to remember this company's dropped quite a lot in the past. Look at this 1 year return, negative 52%. It's trading like a tech stock. All right, so look, let's go to the financials. I like to look at quarterly because it gives me a little more definition, a little higher resolution than what's going on with the company. And you can see that it's had a fairly steady. If you average out the revenue, it's been sitting around the $150 million mark. For the last 10 years per quarter. So it's had some bad quarters, had some good quarters. It underwent a lot of changes. Now, the first time I made this video, I wasn't sure what the changes were, and it wasn't really relevant because of other metrics that I'm using to evaluate the company. But they've underwent a lot of changes. They split their business up. I think outdoor brands, they spun that off. And then they've had to move because of regulatory issues to a different state. So there's a lot of stuff going on involving those aspects. But change is inevitable. Like, this company is always going to be undergoing change. In fact, any company is going to be undergoing change. If you're stagnant and you don't change, you get outcompeted, and eventually you shrink down and disappear. That's just how the game goes. Now, this company has been around for more than like 160 years or something like that. So they know how to survive as a company. I know that the people change, but hopefully the culture stays. The brand is pretty strong. And because the brand is strong, everybody knows Smith & Wesson. I know that there's some underlying value there that even if the company goes bust and is controlled by idiots at some point in the future, which very well may happen, the brand's still going to get bought out by someone else. So there's some kind of backstop there. And this company is not going to go to zero anytime soon, if ever, at least in our lifetimes. Back to the analysis here. We took a look at the revenue, and you can see that last 1, 2, 3, 4, 5 quarters, call it, the revenue has been steadily declining. This is probably the lowest demand for Smith & Wesson since like 2013, and it's even lower than that in this past quarter. So it's very, very bad demand for the guns. It's seasonally their worst quarter, and one could argue that a lot of that demand has been pulled forward in the last year, or at least in the last few quarters. So if we take that argument, then it's not really that big of a deal. Like, you just got to average it out. Let's take a look at some other numbers here. I love these charts, you know what I mean? So how about operating income? You can see it's only 4 million. I'll come back to that figure in a little bit. Actually, why don't we look at net income? 3.31 million for the quarter, which is very poor, but not that far off of some of the numbers that the company scored in 2013, 2016, 2018. So it's not the end of the world, but it's pretty low. I want to come back to that number in a little bit. Let's see what the company's been doing with all this excess earnings that you can see here during the last couple of years. Well, besides paying out dividends, they've been buying back stock. Just like any company without any growth prospects, when you get a windfall, you return the capital to shareholders. So I wouldn't mind if they used the capital for product development or some other strategic use. I don't mind that either, but returning capital to shareholders is about neutral. I mean, if there was a trend, I'd rather the trend of shares outstanding be going down than up. What that means for those of you that are less educated on the topic, not that I'm some guru, I'm just an individual investor just like you, but shares outstanding means that if they're decreasing the shares, that means if you bought 1% of the company like a year ago and then decreased the shares by half, you now own 2% of the company, okay? Because the shares outstanding are less and you own a greater percentage of the shares outstanding. Pause, rewind, listen to that again, I guess. All right, if it's unclear. So moving on, dividends per share, you can see they've been increasing their dividends. They started paying dividends in late 2019. 2020, it was 5-cent dividend, then 7.5 cents after that for 4 quarters, and now they increased it to 10 cents. I think there's another dividend coming up, which is pretty hefty. It's a pretty hefty dividend. So a lot of the cash that they have in their chest is being returned to shareholders through stock buybacks and increased dividends. All right, let's move on here. Oh, I like to look at the profit margin while I'm here. It's only 3.9% at the moment, which is extremely low. But again, not like we haven't seen this in the past. The profit margin over the last 2 years has been it's pretty much around 20%. It's pretty hefty. Okay, now statistics time. Let's look at the market cap versus EV. So enterprise value is 400 million versus market cap 473, which tells us right away that the company has about $74 million on their books, and they're using that to pay their dividends and buy back more shares like we discussed. So here's their balance sheet. Net cash $73.13 million. Net cash per share is $1.6. So other metrics of importance that we're going to look at later. I have a very scientific measuring scale, by the way. We're going to employ that later. All right. I have the super professional polished scale for rating stocks, which is called the Kitty scale of rating stocks. So yeah, that's what I'm going to use. We'll use it in a second once I'm done here. Okay, so balance sheet, walked over it. Other financial metrics, you can see the ROE, ROA, ROIC, pretty good margins. And revenue per employee. These metrics I actually kind of like. I like to look at it, how much profit or revenue they're making per employee. It's useful. It's relatively low compared to other companies, I guess, but it's not too bad. So taxes, they of course pay a lot of taxes. And this is smoothed out profit margin of 18%. Okay, let's look at EV versus free cash flow. It's 67.47, which is fairly high. That's not a good thing. All right, Now, you can buy this, the enterprise value of the company, basically, you can buy this asset for generating this many millions per quarter for only 400 million. And that's actually, I think, a very, very attractive price. I did some mental math, all right? And I figured out that, to me, this company is worth not 400, but about 500 million. So I would say, another, what is that, 20%? 25% up from here, somewhere around the $15 mark, maybe, I don't know, $13-14 mark. That's what I think the company should be at, and that's why I tried to scale in. I was so impatient to get into the company because I saw it dropping from 20 and 16, 15. I was like, okay, it's time to get in now because it's not going to get any cheaper. And now, of course, at 10.35. But that's my personal story. We don't need to dwell on it. Let's do some kitty rating. How about that? All right. You guys ready for this? Okay, so I have a few criterias that I use for the kitty rating. And number one is going to be the revenue trend. All right. So the revenue trend, we looked at it and it wasn't that impressive. It was kind of flat. Let's look. How about we look at it again? Financial quarterly revenue trend is actually going down. It will bounce back. I listened to the earnings call, so you guys don't have to. And what they said, basically, what they were just discussing and pointing out that this is by far, the weakest quarter seasonally, and they expect sales of their products to increase going into hunting season and whatnot, right? So we'll see if those numbers rebound. I'm guessing that they will, but not nearly to the degree they did in the past couple of years. So revenue trend is actually pretty bleak. So what we're gonna do is we're gonna put a point into the sourpuss category. So that's one negative for Smith and Wesson. And this, by the way, this rating system is gonna tell us, hopefully help us answer the question if this stock is a buy. So the next on the agenda here is the earnings trend. So we go look at the earnings trend. Net income is going down. So the last 1, 2, 3, 4, 5 quarters had a bad earnings trend. That's for sure. Another sourpuss. Now it's 2. This is not looking good so far, is it? All right, dividend payout ratio. So let's go to the dividend tab to answer this question here. What kind of rating are we going to give it? Dividend is really high. It's 3.48%, way above the S&P 500. Payout ratio is only 13.2%. Now we got to remember that this is for annualized, I think. And dividend growth is 38.46. So these dividend metrics are massive. This company is dedicated to returning capital to the owners. We're going to do an approval cats rating of 1 here. Put 1 in the approval cats rating. Next, share buyback trend. You guys saw that. We don't need to dwell on this. This is definitely an approval cat. They're buying back shares. Cash on hand. We saw that they had $73 million, quite a bit, considering the market cap is $473 million. So 3 approval cats. This thing is turning around quite quick. It's bouncing up, kind of like the March 2000 lows. Okay, price to earnings ratio. Go to the statistics to find that out. The PE is 4.01, which is at least half of what this company would normally be trading at, or should normally be trading at. So investors are pricing in a 50% decline in earnings. I would say that is a very good PE ratio. I don't, inflation, at least nominally, earnings are not going to go down that much. I am betting. If they are, then we're all in trouble. All of us owners of this company are in trouble. Enterprise value to earnings, so EV to earnings, is basically the same thing, less cash. It's 3.31. I mean, this thing's trading like a resource company. We got to give it another thumbs up, cat. So this thing is bouncing super hard. It's bouncing like Square after the March crash. 2 down, now 5 greens up. Next on the chopping block, it's enterprise over free cash flow. We saw that. That was kind of disappointing. 67.47. So that would be a sourpuss. Okay, we got a little correction, a little mini bear market. Next is profit margin. Profit margin recently, okay, we have profit margin trend. So annualized, the profit margin is actually pretty good. It is 17.97%. So that's not bad, but the profit margin for the latest quarter, if you saw, is the quarterly profit margin for the latest quarter is only 3.9% after being at 19.9. It's a huge drop. So the trend is down, but the profit margin in general is pretty good. So I would say 6 purple cat, no board kitties yet, and then 1 sourpuss. And then the story, okay? The story for this company, we gotta rate the story. Now, what's going on with this company, okay? The company is undergoing a lot of change. Like I just mentioned earlier, every company, if it were to survive, has to constantly be going through change, and change costs money, okay? It costs time, costs everything. It's very difficult. It's easy to just stay in your lane forever, but the thing is with that is if there's no change, there's no growth, there's no evolution, there's no competitiveness, there's no nothing, and you just eventually get out-competed and die. So that's how the companies work. Change is necessary, and unfortunately we have to price it into our models or our way of thinking, or however you're thinking about stocks. So, they're moving, they're spinning things off, they're purchasing shares, they're changing things, products, introducing new products, trying out new things, and then all these experiments and maneuvers, they cost energy, right? They cost money, cost everything. So I think that's partly why the company is a little bit undervalued, at least relative to what I think, but I think it's too undervalued. I mean, a $10 per share, $400 million company that spits out, a huge potential profit per quarter, I think it's a bit of a crime. Now, it's a well-established company, so it's not like something that's on the rise like a Tesla or some other like Square, like new brand that's shooting off and taking over commerce. It's a well-established brand. Everybody knows it. If you don't know it, like, you know it. if you're into their products, if you're into guns and weapons, like, this product, this name. So they're not gonna probably gain new customers. They're not gonna lose old customers. So, to be frank, it's a little bit of a bored kitty. All right, nothing going on here with the story really. There are plenty of things that influence the stock. Like, it's very politically driven. Sometimes there's bursts of buying from time to time, and you just have to roll with it. It's a bit inconsistent, and that's probably why even more premium is taken out of the stock. But I think from what I gather, the management's okay so far, so they shouldn't be doing too many mistakes. I like the fact that they realized that the growth is a little bit capped, although I wouldn't mind if they ventured into trying to grow their market. So they're returning money to shareholders in two ways, and because some people prefer one way, some people prefer it the other way. I like that they're doing both because it gives investors kind of like flexibility options, etc., to maneuver within their investment here. So they want to definitely keep the shareholders as owners, and they're rewarding them for that. So I'm being rewarded currently, although the stock price is plummeting. At least they're buying back shares and expanding dividends. So that's the story. But look at this. When it comes to like the final conclusion, right? If we go into the profits, okay, the net income. Now the last one was 3.31 million. Now would you pay 400, right? Would you pay 400 million for a business with no cash in the bank, just for 400 million, for something that churns out 3.31 million of net income, let's call it, per quarter? So that is roughly 13 million per year. Now it would take you quite a long time to make your money back, right? I mean, if it's 10, then it's like 40, maybe like 35 years to get your money back. It's not horrible. That would put us at a PE roughly of 35. That's another way of looking at it. Now, but it has potential for more, right? It has potential for more. Like if we look at this net income and just take the previous quarter, how about the previous lowest quarter, right? It's 30 million. No, that's 10 times higher. 10 times higher. Forget about all these 2 years. Let's just write those off as anomalies. Let's take a look at one of their worst years here, okay? So this is about like a $7 million quarters on average that they're doing, let's say. They had a couple bad ones. All right, they were undergoing some changes, etc. But even going back further, they had a bunch of $30 million quarters plus. But let's just take a look at these and we're like, okay, 7. Now, 7 million a quarter, that's almost 30 million per year. So that would put us at about, let's say 3 times 4, 12, 13, 14, 15 PE, okay? Like if you just had the earnings of 2018, we would be in 13, 14 PE. It would take us 13 or 14 years to recoup our entire investment in net earnings. So that's not a bad deal. Okay, that's not a bad deal. And my bet is that the earnings are going to look something more like 2013-14, where we had plenty of quarters that are $20 million plus. The worst quarter back in 2014 was $5 million. Okay, and then there was a $21 million quarter, $14 million. So if we assume an average of 10, right, then we have a 10 PE, $10 million per quarter. Then we have, 10 times 4 is 40, times 10 is 400. So there we have it. So we have a 10 PE stock, and I think that's exactly where it should be valued. I think it should be somewhere in that range where we're expected to average out about $10 million of net earnings for the stock per quarter. Obviously, the swings are wild, but I think that's where we're at. And that puts us at 10 PE. I think it's doable. I think 10 years is fair to ask to return your money back, especially on a stock that's been around for so long and it's got such big tradition and survival ability. Of course, and it also has the potential for upside surprise. You can't count that out. Downward surprise too, but not as much as the upward surprise. There were quarters in this company, right, that were, look how high it reached. 52 million, 62 million per quarter, 89, 76 million earnings per quarter. So these are huge windfalls, okay, huge bonuses. That's $90 million, right? 1/4. This company has the potential, might not happen again for quite a while, even in our lifetime, but it could. But it has the potential to return 1/4 of the value of the company in a quarter. In a quarter. Right? You string 4 of those together, you got the entire value of the company. You got all your money back in a year. If this ever, if the buying of this company's products surges to such extremes again. Now that's fairly insane. You get the entire company for free. For free. Now tell me that's not a good deal. How's that not a good deal? It's a good deal. Anyway, let me know what you think about the company, especially whether if you own it. Alright? Peace out.